The American auto industry is more than just a business. It's a cornerstone of the nation's economy and a symbol of its industrial might. For over a century, names like Ford and General Motors have built cars, communities, and the American middle class. The assembly line's hum has long been the heartbeat of cities across the Midwest. This industry is a complex web of suppliers, manufacturers, and dealerships, all fueling a significant portion of the country's economic output. The automobile represents freedom, mobility, and the spirit of American innovation. But today, that engine is sputtering. The global landscape is shifting, and China has emerged as a powerful competitor. Decisions made in Beijing now directly impact factory floors in Michigan and Ohio. Profits from the world's largest car market have slowed, replaced by fierce competition and restrictive trade policies. This essay explores how China's bold moves, from tariffs to EV dominance, are shaking the U.S. auto industry and what it means for American workers and consumers. The industry stands at a crossroads, fighting to maintain its relevance in a rapidly changing world. The once thriving auto trade between the U.S. and China is now a battleground. Earlier this year, Beijing imposed tariffs up to 150% on U.S. auto imports, retaliating against Washington's protectionist measures. Iconic vehicles like the Ford F-150 Raptor and Mustang became prohibitively expensive for Chinese consumers, forcing Ford to halt all U.S. vehicle exports to China. While the numbers weren't huge, the symbolic loss was immense. These cars were brand ambassadors, connecting American brands to China's wealthy consumers. This trade war is the culmination of years of escalating tensions, starting with Trump-era tariffs and continuing under Biden. China's move was a political statement, signaling its willingness to inflict pain on a signature American industry. For Ford, GM, and Tesla, the new tariffs have shattered their global strategy. The old plan, build high-margin vehicles in the U.S. and export to China, is now in tatters. Companies are forced to rely solely on their China-based factories for sales within the country. The Great Wall of Tariffs has split the American and Chinese auto markets, creating two separate ecosystems. U.S. automakers must now fight for survival on China's turf, under China's rules. The era of easy access to China's market is over. The stakes for American automakers have never been higher. Behind its trade barriers, China's auto market is in turmoil. Years of aggressive subsidies led to massive overproduction, leaving the country awash in unsold cars. Chinese automakers can now produce nearly double the 27.5 million cars they made in 2024. A brutal price war has slashed profits and pushed the industry to the brink. Dealerships are forced to sell cars at steep losses, and only 30% are profitable. Massive car graveyards and gray market dumping have become common. Foreign automakers, including U.S. giants, are caught in the crossfire as their market share plummets. In 2020, foreign brands held 62% of the market. By mid-2025, it's just 31%. This crisis is fueling China's global export push as automakers look outward to offload excess inventory. China's domestic chaos is now a global threat to established automakers in the US and Europe. The golden age for American automakers in China is over. Ford's annual sales in China have plummeted from 1.3 million in 2016 to just 400,000 in 2024. The dream of endless growth has been replaced by shrinking market share and intense financial pressure. Price wars and the need to compete with nimble Chinese EV startups are eroding profits. The days of selling slightly modified American models are gone. Chinese consumers now demand cutting-edge tech at lower prices. GM's joint venture, SAIC GM, once a crown jewel, is now offloading thousands of unsold cars at steep discounts. Tesla, once the EV king in China, faces fierce competition from BYD, NIO, and XPeng. Price cuts have eroded Tesla's premium margins. American pioneers are now fighting to stay relevant in a market they helped create. The battle for China is now a struggle for survival. The future for U.S. automakers in China is more uncertain than ever. China has seized control of the global EV landscape. In 2025, it will produce two-thirds of the world's 20 million electric vehicles. Chinese companies like BYD and Geely have achieved efficiency and cost control years ahead of American rivals. Massive government support and a tightly integrated supply chain give them a decisive edge. Chinese EVs start under $10,000, while American models rarely dip below $35,000. With domestic demand saturated, China's factories are exporting aggressively to Southeast Asia, South America, and Europe. Chinese EVs compete not just on price, but on technology and design. This export wave is a fundamental challenge to the established world order in autos. U.S. automakers now face a two-front war losing ground in China and battling Chinese brands abroad. China's mastery of the entire EV ecosystem creates a self-reinforcing cycle of innovation and cost reduction. American companies are struggling to keep up. To block a flood of cheap Chinese EVs, the U.S. has built a wall of tariffs, 25% on imported Chinese vehicles and more on key materials. This has kept Chinese-branded cars out of the U.S. market, buying time for Ford, GM, and Tesla to catch up. But tariffs come at a cost. Higher prices for American consumers, and less incentive for domestic automakers to lower prices. Critics argue that protectionism stifles innovation and forces families to pay more for new cars. The federal EV tax credit, a key incentive, expired in September 2025, making electric cars even less affordable. Automakers like Hyundai have offered deep discounts to offset the loss, but the market faces headwinds. Without subsidies, U.S. battery EV sales in 2030 are projected to be 40% lower than previously forecast. Sales are expected to stagnate, mirroring Germany's downturn after ending its subsidy. U.S. automakers are protected from Chinese competition, but losing government support for EV adoption. They're trapped between tariffs and a shrinking domestic market. The EV transition is becoming a harder sell to the American public. With exports to China blocked, American automakers are pivoting. They're transforming Chinese factories into export bases for the rest of the world. Ford now builds vehicles in China for Southeast Asia and South America, leveraging China's cost advantages. This strategy raises tough questions about the future of American manufacturing jobs. The companies once seen as pillars of the U.S. economy are deepening their reliance on Chinese manufacturing. GM's SAIC GM joint venture and Tesla's Shanghai Gigafactory are also key export hubs. The global automotive map is being redrawn. The old model of national industries is giving way to a China-centric supply chain. American brands are adapting to survive, even if it means building cars far from home. The new reality is complex, but unavoidable. The global auto industry has shifted, and the American landscape is being reshaped. China's tariffs, market crisis, and EV dominance have created a perfect storm for U.S. automakers. The era of easy profits from China is over. American companies now fight a defensive battle at home, shielded by tariffs, while struggling to compete abroad. For workers, the future is uncertain. Global competitiveness may come at the expense of domestic jobs. Tariffs protect some jobs, but encourage offshoring and reliance on Chinese manufacturing. The promise of green jobs faces headwinds from a slowing market and fierce competition. For car buyers, prices are likely to rise, and choices will be limited. Without Chinese EVs, there's less pressure for U.S. automakers to innovate on cost. The industry is at a historic inflection point, forced to innovate, control costs, and rethink global strategy. The future will likely mean a smaller U.S. footprint in China, more reliance on Chinese manufacturing, and a protected but expensive domestic market. The road ahead will demand resilience and adaptation from an industry that once defined American strength.